Good afternoon, ladies and gentlemen, and welcome to this, what I hope will be our first Zoom seminar. You're all very welcome, and thank you for taking the time out of busy days to join us. Strange times indeed. I suppose, first of all, to say we are very much open for business, and we would like to thank you for your business and your ongoing business. I suppose one of the things that's happened is, certain days you've loads of time on your hands, certain days you don't. And we're certainly finding that a lot of clients are doing a root and branch review of everything, all those pesky DDs. What's that Irish Life one? What's that AVA one? What's that other one? We're certainly finding an awful lot of clients are going through those just to find out, are they fit for purpose? Do they make sense? Are they at the right price at the moment? Looking at pension policies, ARF policies, investment policies, even digging up old paid up policies in, what are the charges, is the structure correct, etc. Where are my assets invested? What are my fund choices? Am I correctly invested? And for all of that, and we'll be getting details out to everybody, we are definitely 100% here. Just a little housekeeping with regard to hello, are we okay? Yeah, we are. A little housekeeping. We're going to keep the Q&As to our expert speakers to the end. There's two ways you can ask a question. One is you raise your hand, which isn't raise your hand. As I thought, it said there's a little button that raises your hand, and our moderator Catherine will bring you in at the end. Or secondly, you can type in your question, and one of our expert speakers will address. We do have some new clients, thankfully, who's joined us today. You're very welcome, as well as our existing. So I'm just going to run through very briefly a little bit about Finance One, about our team, about our services, and then one aspect that has come into the news in the last little while with regard to taxation and COVID and the like. Just moving on there. Most of you will know our directors, Conor Sheeran and Heber O'Farrell. And then we have a large group of advisors. Finance One, believe it or not, is actually growing. We bumped up our team with the arrival of Shane O'Rourke, and the mortgage team has gone from strength to strength as well. So one of our advisors will be in contact with you after this, just if you have any queries on anything that was discussed. Our two speakers. Delighted to have Marc Coleman, economist, author, broadcaster, advisor to the government, and David O'Mara. I'll introduce them a little bit more formally when it comes to their time to talk. David is head of distribution in Greenman Investments, who are joining us on this Zoom call as well. What do we do in Finance One? General financial advice, a one-stop shop. We will talk to you about your pensions, your investments, savings, life cover, serious illness, income protection, group schemes, tax planning, and moving into Section 72 on inheritance tax. And that's one area that I just maybe like to focus on a little bit. So yes, it's something we might just move on one screen there. Been a good lot of talk at the moment that, with the bailout, the money that's been put aside, for 700,000 people at the moment, no reduction in taxes. There is rumours that one of the lowest hanging fruit from a government point of view, and Mark might speak to this a little bit later, might be capital acquisitions tax. The thresholds have been increasing. Maybe they'll start to reduce over the next little while, and maybe the rate at 3% might increase. The rate at the main threshold is 335,000. We could see that reducing. And what we don't want for any clients is that your children will have to sell a house that you spent 20, 30 years paying off, to pay in inheritance tax. So there is a solution. One of the problems heretofore was that whole of life cover, which covers you for life, seemed to be very, very expensive, had reviews, and just as you were getting to the stage where it was really, really needed, i.e. you were getting older, it became very, very expensive, and people let it go by the wayside. Thankfully, Royal London have brought out a product, guaranteed premium. So none of those horrible reviews, you know, first one after 10 years, then every 5 years, then every year after age 70. So you know the guaranteed premium, no review going forward. Obviously, subject to medical underwriting, and I have got a good few questions on what medical underwriting looks like in the COVID world. It will basically ask you 3 new questions. Have you been tested positive? Have you been advised to self-isolate? Or have you got a persistent cough, fever, or high temperature? If that's the case, once you get an all clear, you postpone them for 3 months. And one of the other things that seems to be about to happen is they're going to reduce the age that people can get life cover. Royal London are sticking to age 74, but there's talk that age 70 might be the new maximum. The big thing about the whole of life is it's suitable for Section 72, i.e. to pay off inheritance tax. And obviously that's something that as clients are reviewing all of their finances, one of the things we're certainly saying to clients are, have you made a will? Have you looked after inheritance? Something that I'd love to have a conversation, and one of our consultants, or Eva or Connor, will certainly like to talk to you about, you know, over the next couple of weeks. Royal London uniquely have also included what they call their life changes option on there. It's an option that it's actually unique in the market, that after you've paid for 15 years and maybe your situation has changed, etc., you can take back 70% of your premiums. Tax-free, you get 70% of your premiums back, or you fix a level. One example, well, I'll go through it in a little bit more detail, maybe individually. Keep your life cover at a guaranteed lower amount. That keeps going until your death. The cost of that is an additional cost of 10%. If your premium was going to be €200 per month, it'll now be $220 to give you this life changes option. So that's it. I mean, we certainly would love to talk to everybody about that if you feel that that's something. Obviously, the lower amount of children you have, the higher the inheritance tax bill might be for them. I'm not going to go through this in much detail. I hope everybody can see it there, but this is just for Tom, who took out 50,000 originally. How much he pay in premiums, how much the cover would be 15 years, 20 years, as you can see there, or what the cashback would be if kind of a change in circumstance. The other thing that I've been asked an awful lot about, and I know some of the people online at the moment, we certainly had this discussion. Where to now for the markets? I don't really know. Since the high was on the 19th of February 2020, my mother's birthday. And the markets dropped, as you can see there, 37, 38, a little bit less for the NASDAQ, right down to the low on the 23rd of March, dropped to 37, 38%. For some unknown reason, up until yesterday, I know there was a bit of a sell-off in the market, 1 or 2% overnight. Markets have rebounded spectacularly, 28%. Where is that coming from? I haven't the foggiest, but it's very important that people realize that, you know, this isn't the end of the world. We saw this in 2008, and I know Mark will be speaking a little bit to that in his presentation. In 2008, if you were in a bog standard consensus fund, evergreen fund, middle of the road balance fund, after the drop in 2008, it was 13 months before you were actually back again. The only time you lost money was getting out. So that's just something to take on board. And I know Dave will have an option if you like a steady Eddie approach to your investments, as opposed to being exposed to something like what's happening in the markets at the moment. So I think without further ado, 5 key selling points to finance. We'll go through these very briefly. We are independent. There's a fantastic team working behind. We're all working. We're all keeping the thing going. We do believe we have a relationship with you, and we are a one-stop shop for all your financial services needs. So please get in contact with something from today's seminar, interesting, or want to pursue the Section 72, just to get a figure. How much would it cost me if I wanted to cover my assets on the event of my death or my partner's death. So my final point is we're open for business and we thank you for your business. Our first speaker is Marc Coleman. He's an economist. He is a broadcaster. He's a government advisor. He was first out of the traps with his book, An Economic Response to COVID-19. He has been economics editor in the Irish Times. He's been a columnist in the Sunday Independent. He's been a broadcaster on Newstalk and Coleman at Large. He's been head of international business development in IBEC. Speaks German, Italian, Mandarin, and Irish. And quite fitting, his last two books, well, maybe not in order, has been Ireland and Germany, Partners in European Recovery, and as I mentioned, An Economic Response to COVID-19. But without further ado, I'll hand you over to Marc Coleman. Thanks, Marc.
So thank you very much, Alan. I wish I could believe all of that. Some of it's true. Most of it's true. Thank you very, very much. Yes, the book, An Economic Response to COVID-19, it is, I believe, the first book written in response to the crisis from an economic point of view. And as the nurses were doing their bit to address the health crisis, I kind of asked myself, what could I do? And having written 4 previous books on the crisis, and Alan was very kind and complimentary about that, and you can see covers of them, I thought, well, a 5th book might be timely. So it was published on the 17th of April. And I'm going to take you through it now. It's a macro bird's eye view of the economic situation in Ireland, but I do believe that it illustrates a lot of the challenges that will face the German economy, except my view as somebody who grew up in Germany and has written about the German economy is that the German economy will come out of this faster. For reasons, I'll leave that till the end of the presentation. So maybe if we could go to the next slide. To cut to the chase, there are 7 key takeaways of this book, and I'm going to hit them with you now rather than at the end of it. The first is that we want a V-shaped and not a U-shaped recovery, and I'll explain a little bit what I mean about that. It needs to be fast as possible and as symmetrical as possible. And that is something that the Germans achieved in the last event that is anything like what we're about to experience, which was namely the post-war recovery, because they designed fast and flexible markets. They had an economic system where both the shock and the recovery were evenly distributed across all sectors. The second thing we need is fiscal monetary cooperation. So the central banks are pumping a lot of money into the system, but that's not going to do much good if consumers and workers on the other side don't have confidence in the economy's ability to recover. And if there isn't a plan, they won't have that confidence, which brings me to the third key takeaway. We need 2 budgets in 2020. We need one for consumers and business to stimulate that demand, to make sure that the liquidity push by the central banking system is matched by demand pull. And then we need an October budget focused on housing, because rather than trying to do too much in one budget operation, we need to have 2 budgetary operations so that we can do a proper job on both reviving the economy and tackling the housing market. And because if we don't tackle the housing market, we will not have any political cohesion left in this country. And if we don't have political cohesion, we won't be able to solve anything. The fourth point or key takeaway is that domestic demand needs to be revived, if necessary, by tax cuts. Alan has very correctly pointed to the capital gains tax issue. I've been a leading advocate in the Irish Times and in the Sunday Independent that politicians should focus on raising revenues, not rates. And very often, and it's the case with capital gains tax, the best way to raise the revenue is cut the rates. I need to get that message across, because there are plenty of people who think that you increase revenues by increasing rates, and it's not the case. And in fact, increasing tax rates could be devastating for the economy right now. The fifth point, I'm not going to dwell on too much. We do have a legacy of national debt from the last crisis. 41.7 billion net cost of the bank bailout as estimated by the Comptroller and Auditor General last year. I supported the bailout at the time, but I did say in my German book that it would need to be reviewed going forward. I'm not going to dwell on that in this presentation except to note the point. Sixth point is that our multinational sector has done extraordinarily well out of the recovery, and we're all happy to see them do well. But I think now, given the low tax 12.5% corporation tax regime that they benefit from, and the much higher burdens of tax and regulation as a proportion of business revenues that apply to the small, medium, indigenous sector, we're going to need some kind of partnership between the multinational and the small business sector. Again, I'm not going to dwell too much on that. And then finally, policymakers must comprise of and reflect business and taxpayers. We have very patriotic public servants. We have people in the HSE doing a great job. But do they understand that the private sector is going to bear the brunt of this? Do they really understand the details of running a business? Because if they can't, then policy measures may be well intended, but they won't be well designed. So I'll move on to the next slide. And this is what I mean by a U-shaped recovery. You can see the yellow line is the external side of the economy. It pretty much hit the bottom in 2009, and it went up at first at a moderate rate and then at an increasing rate. But what you see in the black line is something called gross national income, which is a measure of the more domestic economy. That bumped along the bottom for another 3 years. That's what we need to avoid. And we might note that the external economy, relative to turnover, relative to value added, is a much lower tax part of the economy than the domestic economy. So maybe the next slide would then illustrate a different dilemma. You will see that public administration and health spending actually rose during the last crisis, despite a lot of talk of recovery, of austerity. Public spending actually went up by 6% between 2007 and 2014. By contrast, construction spending fell by 50%, and it's understated on that chart because of the different axes, but construction spending really collapsed. And the result of that is that we lost tens of thousands more jobs in construction than was necessary, and we didn't build the houses that we needed for a growing population. So we might move on to the next slide, which shows that unfortunately, it's a case of deja vu all over again now. These are the latest government forecasts produced by the government in the last week of April, something called the Stability Programme Update. And what they show is that personal consumption is set to fall by around 14%. Government consumption is going to go up by 9%. Domestic demand is going to go down by 27%, but net exports is going to go up by 17%. So we're seeing different parts of the economy behaving in very different ways. And that unfortunately points to a rerun of the last crisis, where the external side bounces up very quickly. The sheltered sectors of the economy maybe, level off. They don't go down, they don't go up, but they're largely immunized. And it is the indigenous private sector and the non-multinational private sector that really feels all of the pain. So the next slide is going to show you some good news. Alan mentioned the SME Recovery initiative, which I'm very proud to be part of. It started just as I was writing my book, and the publication of my book was met by the publication of an expansive proposal to provide working capital to ensure business continuity over the crisis, to incentivize proper usage of funds so that we put money into viable, not non-viable business, and to incentivize prompt payment of creditors, and to deal with the issue of commercial rates, improve examinership, and improve the flow of funding to SMEs generally. I won't go into too much detail, but it's having a strong influence on government policy. And you can see that when we started, on the left of the chart, on the bottom right-hand side, as of the 24th of March, the government came out with measures of 450 million, which were very welcome, but they really weren't on anything like the scale of magnitude we needed. On the other side of that chart, you can see the 41.7 billion bank bailout net cost, and you can see that between that, the government's response is climbing and climbing, which is very welcome. We're very happy with that. But the SME Recovery Group is targeting an injection of 15 billion. We're not quite there yet. The Central Bank of Ireland wants 5.7 billion in sort of liquidity and funding supports, but there are other measures needed, for example, holidays on commercial rates and so on. And that all adds up to 15 billion, which is still barely a third of what we put into the banks, but should be enough to see most of this SME sector through, provided, of course, the lockdown ends within the next couple of months. And the next slide, I also called for a second October budget to deal with housing. And this is where I have to kind of say, I told you so. My first two books in 2008, 2009, they did predict the crisis, but they said, look, we're going to have a strong recovery. We're going to have strong population growth. In my first book, I predicted a population target of 5 million by 2020. Well, we are, as I speak right now, the Republic of Ireland is just passing the 5 million population mark, and we're 7 million on the island. And of course, the logical conclusion of that is that if you go from 4.2 to 5 million between, what was then 2006, or I can't remember the exact census, but it was 2006 or maybe 2001, and 2020, you need to build houses. So that book and the second book strongly argued for house building. I said, yes, we've got a crisis. Yes, we've got a recession, but that's exactly why we need to build houses. We'll provide the jobs, and we'll make sure the younger people have housing by 2020. Unfortunately, it didn't happen. There was so much negativity towards that argument, it didn't happen. So guess what? We have a housing crisis, and it's nearly destroyed our political system. I reopened the debate last July in the Sunday Independent with an article calling, once again, once I'd left IBEC, to reawaken the issue. Nobody really listened in time, and the last election was the result. So to move on to the next slide, we can see the staggering imbalance between what happened between 2008 and 2018. We had an extra 371,900 new citizens in that period of time. Really strong population growth, 1/3 like more people than Cork and Limerick put together coming into the state. And we had 178,000 new families being formed. But we built less than 100,000 new dwellings. And you can see in the little table on the right-hand side how total investment in the economy went gangbusters. Total investment went up 30.8 billion in that period, up 67%. But that was all the private sector. Government investment went down by 36%. And government investment went down by 13 percentage points. Why? Because the priority was current spending. And as I said, that the rest is history. So we might move on to the next slide, which is this narrative that exists. There's a strongly hostile narrative to any kind of tax cuts. There is this idea that we've spent the last 5 years cutting taxes and we've created some sort of paradise for the rich. Nothing could be further from the truth. An analysis of the cumulative impact of the budgets from 2015 to 2020 budgets, that is the budgets implemented between December 2014 and December 2019, the last budget, shows that while those budgets increased annual spending by over 16 billion a year, the net tax reduction was was less than 1 billion. So for every €1 in tax reductions, net tax reductions, we increased public spending by 26 euros a year. So the strong bias or emphasis on policy in the last 5 years has not been on tax cuts, it's been on increasing public spending. So we need to bear that in mind now when we start discussing what will be the right policies to stimulate the economy. And Alan has made an excellent point. The capital acquisition tax, capital gains tax, they're all areas where we really need to confront the narrative that cutting the rate will cut the revenues. It's quite the opposite. It's by cutting the rate even that we might boost demand, boost activity, and get things going again. So maybe the next slide, we'll look at a timeline. It's always nice to divide a crisis into three phases. There's the height of the crisis, there's the recovery, and then there's a normalization phase. And you can see in the red, that's pretty much where we are now. We have detected the cases of COVID. We have our health policy responses. I could go into that, but we don't have time. We have analyzed the economic impacts, and we're beginning now to implement the economic stabilization measures. So you can see I have a little arrow going, we are here. Now we've got to kind of organize the economic stimulus. Some of them are there in the form of what we call automatic stabilizers, but more proactive measures are needed, and that's my case for a budget in July. Of course, to get a budget in July, you need a government by July, which we still don't have. The next phase of the crisis will be the recovery from it, which we hope will begin as early as possible next year, if not later this year. And then the normalization phase over 2022 is going to be dealing with the social and distributional fallout and trying to put the country back together socially. So the sooner we start all that, the better. We don't yet have a government. We have a very welcome accumulation of government measures, but they're not yet organized into a cohesive framework. And hopefully in the next 2 months, we'll see the government, the incoming government, doing that. So we might move to the next slide. I think a crucial issue here, and we've seen it, again, very welcome, very speedy and responsible responses by government on a number of policy issues. But with the temporary wage subsidy scheme, with the design of the liquidity support strategy, with the announcement last Saturday of the back to work protocols, there are a number of key issues where really we could be really benefiting from more private sector insight into how policy is designed. I don't want to go into it in too much detail, but I think a critical element both for economic success of the recovery, but also for political cohesion, is that, you know, multinationals tend to be very strongly represented in policy circles because government ministers, they love to listen to the CEOs of the big companies. The public sector obviously are very strongly represented. They have the unions, they have the government, they're in government. Academics obviously have a very strong voice. They're part of the public sector and universities. I think the worry I have is that the indigenous private sector is not really, it's not that it's being deliberately ignored, it's just it's not being heard loud enough, and it's not sitting at the table in sufficient numbers to influence the policy to design in ways we need. And that's really got to be corrected now. So I'm coming to the end. What I'd like to talk about now is the Ireland-German partnership. Having grown up there as a child, having gone back to work there, and having written a book about it, one thing to note is that Ireland and Germany are one of the best performers in terms of the strength and discipline of the lockdown, and as a result, the speed with which they can exit the lockdown. One difference, of course, is that the Irish lockdown has lasted longer because our testing and tracing response was not as effective as that of Germany. I'm not going to dwell on that, but the positive side is that the discipline of the lockdown itself was very strong in both countries. Why? I think, forget about your ideology, forget about what you think about Merkel or Leo Varadkar personally or politically, but the interesting thing they have in common, Leo Varadkar is a doctor. Angela Merkel is a she's a chemist, she's a scientist. So they're both effectively scientists, and they understand the nature of a crisis like this. So it's the rigor with which they have responded to it that I think put Ireland and Germany in a relatively good space compared to the rest of Europe. And in the next slide, I'll elaborate the other relevance of Germany, namely that if we're looking back in history and saying what event was like this crisis, when was the last time any European country faced the complete reconstruction or revitalization of its economy, well, it was Germany after the Second World War. And you can see at the bottom right-hand corner a chubby man with a cigar and a book. His name was Ludwig Erhard, and he was the genius who drove the German recovery. And he argued for efficient regulation, and don't overload your economy with regulation, don't overload your economy with tax, make sure your SMEs have access to credit. So the Kreditanstalt für Wiederaufbau was built and developed. In the book that we published on Germany 7 years ago, we recommended the creation of something similar in Ireland. And a year later, it happened in the form of the Strategic Banking Corporation of Ireland. One of the things the SME Recovery Group is promoting is to greatly expand the funding and power of that entity. Erhard also said you've got to have efficient spatial policy and planning so that you have affordable houses, and you've got to have competitive markets so that you have low cost of living, and you have to have a fair deal and accountability as between the public and private sectors. So I think they're all excellent pointers for what we need to be thinking about in the next 6 months. And just above Erhard, you'll see a picture of myself and a gentleman called T.K. Whittaker. He led us out of the last deep crisis we had in the 1950s. I mean, really, really deep, systemically deep social crisis when the existence of the country was literally in question. And he reformed the external side of the economy. He got Ireland to open up its external current account by promoting trade and ending protectionism. I guess if I were to put everything in a nutshell, what we need to do next is we need to apply that external competitiveness to our internal economy. Because what Ludwig Erhard did was he made the internal workings of the German economy competitive and effective and fair. And that brings me neatly back to the V-shaped recovery. If you want a rapid V-shaped recovery where all sectors participate in recovery, that's exactly what you need, that internal efficiency of operation. Not a situation where one sector is hugely sheltered and all the pain is suffered by another shelter. That's not only economically bad, it's socially and politically dangerous. So I'm coming to the end now, and I think we have 1 or 2 more slides. And in the next one, just a little bit about me. So Alan has been very fulsome in his praise. My background, 3 years as an economist in the Department of Finance, and then another 7 in the European Central Bank. You can see myself and Jean-Claude Trichet there. I brought the first interview with him over to Ireland. And then I had a decade of, I suppose, thought leadership as a presenter, a columnist, an author, and a hoster of various events. I had 3.5 years directing Financial Services Ireland, which was a great privilege. It was the largest financial services representative body in Ireland. It's part of IBEC. And in the last 1.5 years, I've been a leading international consultant, and I've come back to authorship and policy and event management. So I won't take any more time on this. I'd be delighted to hear from people individually, and you can see my contact details there. And in the meantime, I know there'll be an opportunity for questions later on, but I know you're all also eager to hear from David. So I will hand you back to Alan, and thank you for your kind attention. And Catherine, I hope I haven't gone too far over the 15 minutes.
Thank you, Mark. I think it's heartening for all of us, a lot of us in the SME sector, to know that there's somebody with your experience and your passion is actually sitting at the table to get a spoke in with the big corporations, etc., etc. Please do. I have a couple of questions have come in for Mark already, so please keep sending those in. We will deal with them at the end. Mark's presentation should be winging its way to you from Georgia at the moment. Nice segue there with the Germany thing. Obviously, our next speaker is David O'Mara. He is head of distribution at Greenman Investments, a company that we have a very good relationship with. A number of our online attendees there have investments with Greenman. David has been there since 2011. Prior to that, he's worked as a risk analyst, and risk is a hugely important topic at the moment, if you think back to the way the markets are. And prior to that, he's worked as a tax advisor in Deloitte & Touche. Greenman's motto is managing risk and delivering income. And I think if there was a message from today in terms of investments, that's probably it. We all need to manage our risk. Doesn't mean we have to run for cover, but we certainly have to manage our risk. And obviously, wouldn't it be great if we were getting 4 or 5% per annum, reasonably certain, out of an investment? Greenman was formed in 2005, where two individuals had a conversation regarding investing in one particular asset class in Berlin specifically, and in the environs. By 2020, it has 750 million in gross asset value. Staff has gone from 2 to 44. Greenman have another presentation tomorrow, and it's entitled Consistency in Chaos, which once again harkens back to managing risk and delivering income. Without any further ado, I'll hand you over to David O'Meara of Greenman.
Thanks very much, Alan, and thanks to you and Heber and all the team in Finance One for giving us the opportunity to speak to your clients today. I think Alan's given a really good intro there, and a great segue from what Mark talked about. Obviously very well versed in Germany, very experienced in having grown up there. Consistency and chaos is definitely a theme we're promoting at the moment. We've always, as a company, had very much a focus on generating long-term consistent income. So that's what our whole business model is based on. For an investor perspective, we want the fund that we operate to form a part of their portfolio that will give them a consistent, long-term and reliable source of income and growth for their portfolio. So to do that, we're very much a specialist operator. We only invest in the German food retail asset class market. And the benefit from us from an investment perspective is that we get long-term leases with really secure tenants that are selling necessity-based items. So, you know, all companies do stress tests and run different scenarios. We never thought ours would be, you know, tested by a global pandemic, but that's the situation we find ourselves in. We always would have talked about, and many people in this call would have heard us talk about, you know, the asset class we're involved in being very much defensive and somewhat protected to what's going on in the general economy because of the nature of the goods that are being sold by the retailers. And that has really been borne out at the moment. And no matter what country you're in, whether Germany had a very severe lockdown indeed, or Ireland, which had a similarly severe lockdown, people look around and see that it's your local supermarket, your local pharmacy, your local petrol station. They're the ones that have remained open and will have to remain open for the long term. Somehow we're a bit different as a company. We do this third pillar of our strategy. We talk about operational control. Any service we can do in-house, we do in-house. So particularly when it comes to property and asset management, we can do that because we're specialists in only dealing one type of property. So many companies in our position will appoint a big international property management company to manage these assets and do the lease management. We keep control of that ourselves. And really the benefit of that is we want to have really close ties with their tenants, which we have been able to build up with some of the leading tenants in Europe, leading retailers in Europe, should I say, and that has really been a benefit to us recently when it comes to dealing with the COVID crisis. So if we move on now, we just examine who the main source of income for our investors are, and we're dealing with 4 of the top 5 retailers in the German market. So Edeka, Rewe, Kaufland, and Aldi, which Mark would have shopped in, I'm sure, in his time in Germany. They're 4 of the top 5 food retailers in the European Union. And the Schwarz Group that owns Kaufland and Lidl and Aldi are 2 of the top 10 globally. So from our perspective, it's very important for us to deal with some of the dominant and most materially important retailers in the food industry. Germany very much leads the way in relation to food retail. The discounters have been active there since the 1960s, and it's a very competitive, but also they're very much lead the way when it comes to retail trends across Europe. So we have very good relationships with the top 3 full assortment food retailers in Germany, and it's a market that is very sustainable for us and can continue to generate growth for us for the long term. If we move on to now, we talk about the impacts of our fund. It's important to give a bit of a recap on our strategy, but like everyone, 2 months ago now, when the lockdown got serious, we had to kind of see, well, what was the impact going to be on our fund? And so looking back now, we can see that for the month of April, when the crisis was at its most severe, our property managers were still able to collect 86% of the rent for our full portfolio in Germany. Now that the German economy has been able to open back up, starting gradually and starting with the non-essential retail, we're forecasting we'll actually be able to collect 95% of rent due for the month of May. So that leaves us and our investors in a very strong position to hit target returns that we've set out. The open fund is very much it's 750 million gross asset value, as Alan already said. So there's over 1 billion worth of grocery transactions in our stores every year. So 97 euros spent in a Greenman store in Germany every second. And so it's a materially important fund in the German retail market, and that has given us a lot of credibility in Germany, which is definitely a big benefit for us and our investors navigating through this crisis. When we look at specifically what our goal when it comes to generating income, we look at the potential impacts on the fund. So this fund was established in 2014, and we pay a quarterly income. So since 2016, when we paid our first income, we've distributed shade under 30 million euro in investor distributions, and the most recent one of which was 3.5 million for the first quarter of this year, which was paid in April. From our perspective and the distribution team, I'm in charge of fundraising for the fund and deal with a network of the likes of Alan Fearon and Finance One. So we had subscriptions for Q1 of a little over 30 million, which is pretty much in line with what we did for the first quarter of 2019. And what was very reassuring for us was the level of redemptions out of the fund. So we can process redemptions on a quarterly basis for our investors. And there was redemptions total about 2.8 million. So it was only 0.8 of the net asset value of the entire fund, which is only slightly ahead of the weekly rate of fundraising we've had over the past 18 months. So I think we took good solace from that, and that our financial advisors and our investors really appreciate that the Germany is a safe haven, a safe investment haven, and particularly the food retail asset class that we're involved in puts us in a very good position to keep the consistency in return that we've always been able to manage to date. From our perspective, when it comes to forecasting our returns, based on the assumption, even if we don't hit the 95% target of rental collection for the month of May, on the assumption that we collect only 90% of our rent for the rest of the year, we'll still be in a position to distribute 4.2% of net asset value of the fund to our investors for this year. So I think it's a very strong figure, something that will hold up very well in the current conditions, and something that hopefully will give comfort to investors that are on this conference. Mark has actually probably touched on a lot of this, but just from our perspective, how we see Germany as being a very favorable location in which to invest has always been the same. I suppose and our founding directors are very conscious that a lot of Irish investors, and it's not just Irish people, but people tend to invest very locally no matter where they live. So particularly in Ireland, with a population on the island of 7 million now, and 5 million in the Republic, and we're very much one of the smaller countries out there on the edge of Europe. So to invest in the heart of Europe in a Eurozone economy, and also in the largest and most stable economy was a very key attraction for us. We want to have stability and consistency in the return we generate, and we feel the German economy allows us to do that. So a couple of things just to build on what Mark has kind of outlined. Germany is much better resourced to respond to crises when they appear. So what we've just highlighted here is GDP growth for the period 2008 and to the forecast for 2021. It's obvious the peaks and the troughs, but if you look at the troughs, so 2009 was obviously a pretty traumatic year economically everywhere, and Germany was not immune from that. So there was a reduction in GDP that year of nearly 6%, but the recovery was very sharp. If we look for the forecast for this year, GDP is set to decline by 7%, but with forecast of GDP growth of over 5% for next year. And why is that? So Germany is very much keeping, and it's a bit of a cliche and a bit of a stereotype, but they take a very prudent outlook when it comes to managing the economy, and that's true at the federal level. They've had this black zero, this Schwarze Null policy of having budget surpluses without financing that through taking on additional debt, and that's really a policy of trying to save for the rainy day and not spending what they don't have, and that's put them in a pretty enviable position where they were able to announce a package of supports for for business and citizens valued at estimated €1 trillion, which is a pretty eye-watering sum of money. Half of that, €500 billion, was in the form of interest-free loans guaranteed by the German bank, or by the German government, should I say, available to businesses that may be affected by COVID-19. The policy and the focus is always to keep employees in their jobs where possible through these crises, and that's something they did through the financial crisis, which helped a pretty quick recovery, and they've kind of really dusted off that playbook, and they're doing that again now with the COVID-19 crisis. Allied to the fact that from a medical perspective, the testing capability they had, I mean, some estimates say they were able to do over 500,000 tests a week a couple of weeks into the crisis, meant they were very much able to get on top of the spread of the virus before it became too much of an issue. And that's why they've been able to open up their economy gradually over the last number of weeks. So I think what we'll see, the headline grabbing stuff is the Bundesliga coming back this weekend, I think. But it's very much business as usual in Germany now from a retail perspective, with all essential and non-essential retail and now back open business, which is very good from our perspective as a retail fund manager. So that's a bit of a backdrop to potential impacts on COVID. So I'll talk a little bit about what we see now for our open fund, which is now the largest food retail focused, the largest German food retail fund of its type. So we've come quite a long way since the fund was established in 2004. It has an asset value of 750 million, spread across 69 retail centres. It's a mixture of Fachmarktzentrum and hybrid parks and neighbourhood retail parks across Germany, all with the food anchor at the core. We have rental income of 41 million a year and an average remaining lease term of over 8 years. Crucially for us, we have 81% of the rent comes from necessity retailers, with the balance coming from the fashion, household and other providers. But these retailers that we have aren't selling high-end luxury goods. It's very much the necessity everyday items and not the high-end goods you see in the high street and shopping centres. So that gives us a consistency of income. From our perspective, as a fund manager, for 2019, 2 of the top 10 deals in our asset class were transactions that were undertaken by Greenman. So we added acquisitions valued at just under 300 million to our portfolio last year, and the portfolio actually grew by 58%. So we are actually, over the last number of years, the second largest individual buyer of this asset class, and we bought 6.8% of the total market for these types of properties in Germany. So very much in the German market, German commercial property, the name Greenman is synonymous with food retail, whereas in the Irish investment market, we might be synonymous with Germany and German commercial property. If we flick on to the next slide there, please. Acquisitions are something we get questioned about quite a lot. So what is the acquisition market and what is the mood? But first of all, it's just what our policy is. From an investment manager perspective, we take a very long-term buy and hold strategy. We're not buying property with a view to flipping it in a few years to make a profit. We're just really interested in the income and how sustainable that income is for the long term. So we spend a huge part of our work is underwriting these assets and these deals to make sure that they have the capability to generate consistent returns for the long term for our investors. And what our board will look for is that a 10-year discounted cash flow, can this retail centre deliver cash and cash returns of over 5% to our investors over a 10-year period? And that kind of yield profile is very attractive for us, and particularly for Irish investors who may be struggling to get a return with the way interest rates are, or someone in the post-retirement space who wants to protect their the pot of money they've worked hard to accumulate and enjoy their life in retirement. 2 of the most recent transactions we've entered into, the Project Strong, 74% of the rent paid by Kaufland, which is the Schwarz Group's hypermarket size, the same group that owns Lidl. 112 million transaction, 80.2 million euro in rent, and that's due to complete either the end of May or the end of June of this year. Hamburg is a traditional hybrid centre, a mixture between your local Fachmarktzentrum or neighbourhood retail park and a shopping centre, anchored by 2 food retailers, Rewe and Aldi, costing us 34 million and an additional 1.8 million in income. So these are the typical type of profile of assets that we're acquiring, and from our perspective, it's very much business as usual from an acquisition perspective. what we're seeing in the market is also very interesting. I mean, it's one thing us being confident in the market, but what we've seen since COVID got serious is that there's a lot of money flowing into, particularly Germany as a safe haven. We see Deutsche Wohnen there has issued 5 and 10-year bonds that were 12 times oversubscribed at a rate of just 1.25%. So highlighting the Germany's status as a safe haven location. But also other investment managers entering the market for food retail assets. So Slate, a Canadian fund manager, has just raised 260 million, 60 million more than target to buy German food retail assets. Deutsche Investment, a Hamburg-based fund manager, has raised 300 million to acquire food retail asset class, food retail backed assets. A very interesting comparable in the UK, Supermarket Income REIT, invest 100% in UK supermarket assets. Had been targeting to raise 80 million, has actually raised 160 million off the back of increased investor appetite. And look, all those investors are looking for a long-term secure income with the potential for capital growth, which they are targeting in the UK. So from our perspective, we get quite a good bit of comfort that we're on the right track when we see that they're the only REIT in the UK market that's fully on track to hit all their forecast returns this year for investors. And really, I think there's an appreciation that food retail is very much a safe haven, and that no matter what the market conditions, your local supermarket and your local food retail asset class is going to have to remain open to keep the show on the road for society, really. An interesting point that we haven't really promoted before or highlighted before is we talked about the benefits of us of being sector specialists and not being a multi-asset manager, but how has that really benefited our investors and the fund? So what we're showing here is the last 6 transactions that we've entered into, and the benefit of us being able to price these assets well and get them at better prices than market valuation. So we can see here across these 6 assets, they had a total purchase price of 382 million, should I say. They were actually valued at purchase by our independent valuer CBRE at 418 million. So we were able to buy assets for 9.3% less than their typical market value. And that's passed on immediately to investors in the valuations of our fund NAV. So that's really a kind of a concrete example that we can show to demonstrate how us being a sector specialist, by getting off-market deals and by having very good relationships with tenants and developers, has a direct positive impact for our investors. This is not something that any fund manager who decides to enter the market can do, because they haven't built up those relationships and that positive track record and credibility in the German market. And particularly now, post-COVID, there's going to be a lot of opportunity for us, and the pipeline of potential acquisitions is already building up for us. So we have a locked-in pipeline of acquisitions that we're in various different stages of due diligence and underwriting on, of 315 million that we could acquire over the next 12 to 18 months, all anchored by top retailers in Germany. So from our perspective, we have a target to have AUM in the fund of over €1 billion and get 60 million a year in rental income. And we're still on track to hit that. And we think what's happened with COVID, because of the expertise we built up, means we're better positioned than anyone to take advantage of the opportunities that will come up to acquire really good assets at good pricing, which will be a good positive impact for our investors. And I think that's it for me. I've covered a fair bit of ground there, and I think I've slightly kept to my 15-minute target, but I'll hand you back over to Alan there for Q&A.
Thanks, David. Yeah, very interesting. Obviously, it does exactly what it says on the tin. We have a few questions in, 2 or 3 for Marc. I'll just start the ball rolling. One question here: pensions were an easy target last time out. Can you foresee the chance of another levy, i.e., literally putting their hand in your wallet and taking money out of your, not on gains, not on profits, but a levy on pensions? Marc, you're still muted there, Marc.
I can see an excellent question. I can certainly see that being attempted, but I don't think it has the same degree of success, because the last minister that did that, Minister Marc Coleman, I think that basically terminated her career, and Fianna Fáil really never recovered from that. And I think Fianna Fáil will be in government no matter what happens. It's unlikely that government will be formed without Fianna Fáil. And I think the memory of the damage that that did to the Fianna Fáil party is just too great for it to recur. So I've no doubt that it'll be suggested, but I think it'll be shot down. I think a key difference between this time and the last time is that we are in a better position in terms of the capitalization of our banks, in terms of the net asset liability position of the private sector is much stronger. There's a significantly lower level of private sector debt. Private sector loans are much, much lower as a share of deposits. And the constraint I mentioned is national debt. However, we can borrow now at virtually costless rates. So I think the line of least resistance for government will be to increase the national debt. Now, the extent to which that's fair on the future generation that's probably for another day. But that's what I think is going to happen. I think the political situation and the mainstream parties are too shocked from the last election to try and target pensioners, because pensioners vote, and prospective pensioners vote. So I think it'll be suggested, perhaps by the Department of Finance. I don't think it'll go through.
Hey, Mark, thanks for that. While you're still in the chair, you've kind of hit on two further questions. One was very simply, are the banks sufficiently capitalized to provide the debt that SMEs and other companies might require? And then a further question from Michael. Do you foresee, if there is the changes with the CAT and the thresholds, might there be a suggestion that prior losses will not be allowed in future gains? Answer that maybe separately.
Two excellent questions, but I think they need a little bit more research than I would have had time to prepare for. I think in relation to the first question, just remind me the first question again, Alan.
Are the banks sufficiently capitalized?
Yeah. So we need to note that the Basel III has been revised in a way that relaxes the capital requirement directive. So the banks are under less pressure this time than they were the last time. And that's very, very welcome, because we saw, and I spoke about the importance of policy design at the ground level, the problem that you can have people who are theoretically brilliant, have PhDs, design a policy, but they've never actually worked outside the public sector. And they design policies and rules that don't actually work on the ground. And that caused a lot of trouble the last time. The capital requirements were too onerous. You had mark-to-market accounting rules that required banks to write down property values at distress levels with no regard to their potential to recovery, which resulted in what we call pro-cyclicality, which means you take a bad situation and you make it worse. Well, the good news is that a lot of those rules have been revisited by the European Central Bank, Basel, and the Commission. So as we start the crisis, we start with more flexibility. Ask me in 2 or 3 months' time about the bank capital requirements, and I will have an answer for you. I don't have one now. What I will say is that if we do not bail out the business sector, the small and medium-sized business sector, we will definitely have, we are far more likely to have a banking crisis than if we do not. If we provide effective liquidity to the SME sector now, if we provide effective stimulus to the consumer now, that is the best way of protecting against a bank bailout in 3 or 4 months' time. In relation to the specifics of capital acquisition and capital gains tax, again, I'm sorry that I have to disappoint the questioner. That requires a little bit more detail and research, and it would be wrong to give a steer on that right now. But I'm happy to take a follow-up engagement call at any time of the questioner's convenience.
No problem, no problem. Thanks, Mark. One for David. Paul Farrar just sent in a question. Due to what's happening, obviously, in terms of retail experience, do you feel that investment in property with regard to retail might be affected by online shopping? delivery services. I know they're not up to scratch, but would we see going forward that almost everybody be doing their shopping online, etc., and how that might affect Greenman Open?
Yeah, no, it's a very pertinent question. I think pre-COVID, it's something we would have had kind of as a major part of our presentations, what potential impact of changing habits, shopping habits, and that. And a key pillar there, and it's been kind of, I suppose, exaggerated by what's going on in COVID. Germany lags very far behind other countries in the adoption of online retail, particularly for grocery. So last year, the total value of transactions in the grocery market in Germany was over 250 billion, and less than 3 billion of that is is online. So by 2023, I think the year is, they're targeting, they assume that about 1.4% grocery transactions will be online in Germany. And the main reason behind that really is the profitability. So German retail is so competitive because really the influence of the discounters. They reckon they make profitability turnover margin about 1.5%, versus in the UK maybe between 4.5% and 5.5%. So if you think about it, most retailers, and there's a misconception as to what online retail is. The reality is, in most cases, if you make an order online, it goes to your local store. They need to get someone to get a trolley, walk around and handpick that from the shelves, bring that to a driver who drives around all day and delivers that. So that's very, very expensive for the retailers. So in Germany, and Germans are very price conscious and value conscious, the retailers say, well, not only do we not see how we will make money from it, we don't ever see how we'll make money from it. Now, that's not to say we think that trend won't increase over time, but we feel very much so that the turnover will be done from your local store. So from our perspective as a fund manager, whether there's more floor area given over to retail, or if it's more space is required for click and collect or distribution model, it will be done from your local store. And a good comparable that we have, because it's not such a big deal in Germany, we have to look at the UK. So there's an interesting article recently comparing Tesco and Ocado. So Ocado are one of the new breed of fully online grocery retailers. So in the first weeks of the crisis, they had to stop taking orders for 4 days to try and catch up. But Tesco, who deliver 90% of their online deliveries from your local store where it's handpicked, they were able to increase their capacity in 6 weeks. They were able to double their capacity for online delivery. And they were able to increase their business by 2 Ocado-sized businesses in that period. So they're very much what we'd look to see where the future might be. They're trialing a system now where there's going to be a robotic kind of a unit at the back of a store in a kind of a trial to do those, automatically do those click and collect type models. But from our perspective, things are moving and changing very slowly in Germany, but we will talk to our tenants at all stages and adapt the stores that we have to this omni-channel approach, as opposed to a total abandoning of the existing model.
And Alan, could I come in and support what David had just said from a different perspective, if I may? There's another reason why what David is saying is liable to persist in the longer term, and it's population density. So if you look at Dublin and Berlin, they have the same footprint. It's about 1,000 square kilometers is the size of Berlin, and Dublin County, which is de facto city, is about 1,000 square kilometers as well. But in Berlin, the population is 4 million. In Dublin, it's a little over 1 million. So if you think about it, your average German living in a more densely well-planned urban space can much more easily walk to the local Edeka or Aldi or Lidl, does not need it delivered. Delivery makes a lot less sense in Germany than it does in Ireland. Where what you have in England and Ireland and Scotland is you have population sprawl, you have big housing estates, so that the people, you know, rather than walking 2 or 3 miles to their supermarket, will actually pay that premium for the online store experience. They're far less likely to do that in Germany for the reasons I mentioned.
Thanks, Mark. Sorry, I have 2 further questions. Mark, are you still in?
Yep. Oh.
Sorry, Alan. Alan, are you okay there? Yeah.
Sorry, yeah. One final question for Mark. Any comment on Brexit? as it affects?
I miss Brexit, Alan. Remember the good old days when we just had to worry about Brexit?
Yes, yes.
I think I don't know what the specific angle on the question is, but one other thing I'm working on is a report with the German-Irish Chamber on the capacity of exporters to divert from Britain to Germany. So to give a practical answer to that question, it's a very big topic, and we would really need to, to elaborate it more further. But I'm relatively positive about it in that the Irish economy is now far more diversified in terms of exports than it was 10 years ago. Britain, the UK, was a much larger slice of our exports and employment back then. Now Germany is much more significant. Asia is much more significant. Another book I wrote was called Unlocking Asia's Potential for Ireland. I wrote that in 2014, and our exports to Asia have since doubled. So the great thing about Ireland is, where I use this analogy, we're like a bicycle in a traffic jam. Brexit may come, COVID may come, but this economy is so small, so high technology, and so diversified and agile that if, provided we get our internal competitiveness right, we can quickly find growth sectors. The world economy may be in recession, but there's always growth out there. There's demographically driven growth. There are sectors like the pharmaceutical sector is going to grow out of this. Medical technology is going to grow out of this. High technology is going to grow out of this. Well, guess what? They're all sectors where we have phenomenally strong clusters of companies. So we have the opportunity to grow. The question is, have we got the internal flexibility to adjust our internal economy and to redirect the skills of our workers to those growth sectors? It's the internal competitiveness and agility that keeps me awake at night.
Thanks, Mark. One final question for David, and I'm just conscious of the time, and thank you so much, people, for being so patient. David, you mentioned 86% of rents received in April. How do you manage tenants that are not paying rents? And draws a comparison with what's happened in Bewley's on Grafton Street, where the landlord was not willing to move, and Bewley's end up closing. What's your view on, or how are you dealing with the 14%?
Yeah, so when the lockdown came in Germany, they brought in some emergency legislation, and a lot of it was in relation to defining landlord and tenant relationships. So between March and April and up to September, there's protections for us and for the tenants. So in the case where a tenant doesn't pay the rent, we can't kick them off the site. And then also they can't terminate the lease because they're not allowed to open. So protections on both sides. So we have 14% of the rent. It's a deferral of rent. They are technically still liable for that rent. So we'll be revisiting that in September. But technically we will be entitled to that rent. No, in reality, probably what we'll do is, and what we've done successfully in the past, is use those opportunities to negotiate with the tenant, and might be a rent holiday, and all with the view, from our perspective, our agenda to try to be at a lease extension where possible. So we'd never bite off our nose to spite our face, if that's the phrase. But that's the benefit of us having good relationships with the tenants. So we will be chatting to those, that relatively small cohort in September.
Yeah, brilliant. So folks, I think we'll wrap it up there. That's all questions. Thank you for those that sent in their questions, all on the money. To close, I'd like to thank our two expert speakers, Marc Coleman and David O'Mara, for their contributions. Very relevant, very thought-provoking. I'd like to thank Catherine Chu, our moderator and host, who has, together with Georgia Bean and Finance One, has put the whole thing together. But most of all, I suppose, and I know I speak for Connor, and I know I speak for Harry, and I know I speak for Heber when I say I'd like to thank you, our clients, for continuing to support us in this difficult time, for you and for small businesses. Great to know that Marc Coleman is sitting literally at the table, putting our voice forward, and that we do have investment options in the less risky space through Greenman. Slides should have all made their way to you. Once again, thanks Georgia, my contribution, such as it was, David's contribution, and Mark's contribution. We have a hungry team. We've got the old guys like myself, Heber and Connor, but we've got a young team ready, willing, chomping at the bit to support you. Get those policies out. Let's have a look at them. Let's review them. And let's have a conversation over the next couple of days or couple of weeks. So please feel free to get in contact with ourselves, with regard to anything that we. On that note, I just say thanks, guys. Stay safe, and we'll be in contact soon.
Thanks, Alan.
Thanks all.